I think silver could trade $100 an ounce by next year. I don't expect gold to make that large a percentage move, although I do expect gold to be above 5,000 next year. So both metals should still be purchased, but I still think that even with this move, you still want to make sure and be buying some silver along with your gold.
The best consensus is $80 silver, and that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200.
Precious metals extended their powerful rally as silver surged past multiple technical ceilings, pushing well beyond its previous all-time highs with remarkable ease. Gold followed with a highly energetic session of its own, posting a substantial intraday advance that carried it toward one of its strongest monthly finishes on record. Silver's strength has been exceptional, delivering sharp daily and weekly gains, and marking one of its most impressive monthly performances in recent years. With year-to-date momentum already placing 2025 among the standout periods in modern market history, analysts emphasize that December is likely to deliver additional upside as capital steadily migrates from weakening sectors into the safety of precious metals. Peter Schiff, CEO of Euro-Pacific Asset Management, emphasizes that this accelerating rotation aligns precisely with the long-term trend. He points out that silver has now taken clear leadership over gold, validating the broader breakout and signaling the start of a more powerful bull market phase. Schiff has long argued that silver was significantly undervalued relative to gold, and he emphasizes that the rapid narrowing of that valuation gap reflects a deeper structural repricing. His outlook projects silver reaching the triple-digit zone next year, potentially around the $100 level, while gold breaks decisively above the $5,000 mark. He also points to the sharp resurgence in mining shares, which have shifted from lagging indicators to standout performers. Schiff further emphasizes that this rise in precious metals is unfolding precisely as cryptocurrencies enter a pronounced corrective phase. Major digital assets and related equities have recorded steep declines, while gold and silver continue to climb, underscoring the point that investors are reconsidering which assets provide durable long-term protection. With central banks maintaining strong gold purchases, global deficits widening, and expectations rising for rate cuts well into 2026, Schiff emphasizes that the macroeconomic backdrop remains overwhelmingly supportive of higher metal prices. In his view, the broader public has only begun to take notice, and the most dramatic acceleration will occur once mainstream investors actively pursue the trend rather than observe it from the sidelines. Now, we present the clips from Peter Schiff. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
This is a real black day when it comes to the gold and silver mining companies. They are going to make a fortune based on the moves that we saw today. Silver ended a great week and a great month, up over $3 an ounce, new all-time record high. We're trading above 56.30. I think I just saw it trade above 56.40. I was watching March futures, and there the contract was trading well north of $57. So we're blowing through the high. The previous record high that we set about a month ago or so was around 54.40-ish. So we went right through that, through the 55 handle, and then through the 56 handle. Gold, not too shabby either, up better than $60. I think I just saw it up $65, trading at $4,220. It's not a new record high, but it's getting close, probably on a monthly basis, because this is the last day of November. And on a monthly basis, it probably is a new high for the month. In fact, it may even be a new high for the week. I'm pretty sure that it is. In fact, looking at how the precious metals have performed, silver up 6% today, which is, startling by itself, but it's up 13% on the week, 16.5% during the month of November. What a November to remember. But I think we may get an even more memorable December, because I think we're going to get a big follow through. Year to date, silver is now up 95%. Think about that. And the year isn't even over. We still have another month. So I think we're going to end up with a double in the price of silver in 2025. Gold up about 1.3% today. On the month, up more than 6%. And on the year, still up better than 60%. But silver is now outperforming gold year to date by about 50%. Now, this is something I have long been forecasting on my podcast and on these weekly market wraps. I've been saying that silver would eventually wake up from its slumber and take the lead and outperform gold. And that is exactly what it's doing. That's why I've been so bullish on silver, and I've been recommending that all of the Schiff Gold customers buy silver too, not just gold. In fact, I've been recommending more silver than gold this year for the specific reason that silver was so cheap and you had a long way to go to catch up. Now, it's still cheap. Clearly not as cheap as it was, but I think we have tremendous upside potential. I think silver could trade $100 an ounce by next year. I don't expect gold to make that large a percentage move, although I do expect gold to be above 5,000 next year. So both metals should still be purchased, but I still think that even with this move, you still want to make sure and be buying some silver along with your gold. And the fact that silver is now leading gold higher, this is very bullish. This means that the precious metals bull market is much stronger because in the past, gold was leading silver. In fact, it was dragging silver, almost kicking and screaming like it didn't even want to go up. And that was one of the negative divergences in the precious metal space. People would be doubting the gold market because they weren't getting the confirmation from silver. Well, now we've got that and then some. We've got silver even stronger than gold. That's what you want. This new leg of the precious metals bull, which is being led by silver, is going to be even stronger. So gold is going to make even bigger gains now following silver than it did when it was leading silver. And the other divergence was the failure of the mining stocks to perform. Well, that's all changed. They've had a great week. The GDX up 13% on the week. The GDXJ up 16.3%. But more important, the year-to-date gains in the GDX at 145% and the GDXJ 157%. That's why in Q1 of this year, if you remember, I came out with a special report, the best way to buy gold, and it was to buy the mining stocks. And at that point, the mining stocks had barely moved on the year. And now we've got this spectacular gain because it was crazy to me that we had $3,000 gold, yet the gold stocks had made no progress since 2000. We had a 50% increase in the price of gold, and the miners had barely moved. I knew they would catch up, and they have caught up. But more significantly for gold and silver is the fact that the gold and silver mining stocks were lagging, right? They were not confirming the move in gold. That was a negative before. Just like silver wasn't validating gold's new highs, neither were the mining stocks. And a lot of people looked at the mining stocks as an indicator, and they didn't believe that the gold rally was real because they weren't seeing it priced in to the mining stocks. And I kept saying that you should ignore the weakness in the mining stocks because they reflect the views of the Wall Street analysts who didn't understand why gold was going up, and they didn't expect it to keep rising. And so they didn't factor higher earnings into the gold stocks. In fact, because they all expected gold prices to collapse, they thought that the gold stocks would go down even more. And so that's what kept them on the sideline. But now it's clear that we have confirmation. The gold stocks are not lagging. They're also leading. They're now outperforming gold, which is exactly what should be the case in a healthy bull market. So we've moved from the early stages where it's just complete denial to the next stage. We're not even near the final stage. So don't even think that, oh, it's too late to get in. You know, now it's a blow off top. We're years away from that.
According to Andrew Maguire, the gold and silver markets are now displaying unmistakable signs of extreme physical tightness as major buyers rush to exchange weakening fiat holdings for real, deliverable bullion. He explains that futures-to-spot backwardations, something that should never occur in a healthy market, signal that the December gold and silver contracts on the COMEX have been fundamentally mispriced. This mispricing exists because the Western paper market is bloated with synthetic, unbacked supply operating on extreme leverage, while the true global price is now being discovered through T+1 physically settled mechanisms and increasingly through the BRICS-aligned SGE and SGI hubs. These Eastern markets, which deal in actual deliverable metal, are steadily siphoning liquidity from the legacy Western system, creating a growing price disconnect that large sovereign and institutional buyers are quietly exploiting. Maguire notes that the arbitrage between diluted Western futures prices and real physical costs has grown so large that any attempt to source meaningful size immediately triggers higher premiums, revealing how scarce real bullion has become. As these mispriced Western contracts approach expiration each month, massive derivative positions must be marked to market, compressing synthetic prices and triggering frantic short covering by actors trying to unwind unbacked positions before physical demand forces a repricing they cannot absorb. Maguire predicts that this structural tension will ultimately snap the paper market, triggering a violent repricing event that could send silver surging into triple-digit territory and gold to levels far beyond current expectations. Let's now have a look at Andrew's thoughts.
Is for stackers to be able to shake off the smoke and mirrors legacy market shackles and to join forces with every single central bank and sovereign investor now racing to exchange their rapidly debasing fiat currencies, treasuries, for real-world zero counterparty risk bullion. There simply isn't enough above-ground bullion to meet this demand at current prices. That's true for both gold and silver. So let's start with the first clue, the unprecedented backwardations. This is an action call and a massive opportunity to front-run the next leg higher. Futures market backwardations to spot, what they do is telegraph the legacy December gold and silver futures prices, which we've just been tracking, have been physically mispriced. Now, hang on, this is the largest price-setting futures exchange globally, paper futures, cash settled. So basically, these December contracts, which everyone looks to for a reference, have been physically mispriced. And while the spot market is influenced by these diluted prices influencing the local London fixes, where deliverable bullion can be sourced, because it's diluted with synthetically generated, unbacked 96% leverage COMEX supply, the exponentially larger global-facing T+1 deliverable, i.e. must be delivered under Basel III compliance rules. Anything that turns up at the fix must be T+1 deliverable, one-day deliverable physically. So these T+1 spot market fixes, they ultimately determine a global market deliverable price, and it's underpriced. However, physical market liquidity has broken free of the West's toxic gold price concoction, that's all I can think it is, into the BRICS-centric SGE and international-facing SGEI physically settled trading hubs, where a competing real supply-demand price is fixed twice a day. Now, this price is a real price. This price feeds into the rapidly expanding Western-facing gold corridor, pushing back where Western paper to global physical differences are systematically arbitraged by central banks, sovereign, and very large institutional buyers who have exited these COMEX exchanges, understanding, as the central banks do and the sovereigns do, that this is a 54-year-old legacy marketplace that is so deeply underwater from a paper to physical perspective, they become vulnerable. They're literally being targeted for this bullion. So what we're seeing is when we see periods of backwardation, this activity to arbitrage these differences actively steps up. I mean significantly. So futures to spot foreign exchange backwardations can only exist following the creation and selling of synthetic leveraged gold supply, which determines the non-deliverable cash settle price, which is so blatantly at odds with the global physical supply demand prices. However, those that look purely are siloed within that COMEX exchange. A lot of US traders look, and the speculators, momentum traders, chasing a dot up and down a screen, they don't see anything beyond that is the price to them. And it really is why they're wrong at both ends when suddenly they see, hey, hang on, what used to work doesn't work. So quite simply, the larger the size that I or anyone else or client wishes to buy, exponentially increases the price above the published prices, even the FX fixes, which are limited to 3 to 5 tons out of the 600 to 800 tons of unallocated gold that sloshes about. So if I want big size, then you just literally index that and add the premium. So what people try and do is literally just nibble at it without taking too big an order, because what it does is exponentially push that price up. However, when you've got a price being set outside of the legacy market, it's almost irrelevant. So whereas the global facing liquidity providers servicing very strong unleveraged physical central bank sovereign institutional demand, while they stealthily arbitrage these mispriced exchanged for physical basis spreads, i.e. the difference between this underpriced COMEX bullion, it's not bullion, this underpriced synthetic gold versus the real cost to buy that, even though it may be diluted slightly in the West still before it enters the gold corridor. That basis spread, EFP basis spread, is definitely stealthily being arbitraged without raising too much drama. So short-term chart chatter that you look at aside, and again, deliberate chart chatter. In other words, excuses to pull the bids. Really, as we've shown in the videos, in the chart sections, how pit managers come in, how options expiries, derivative expiries, mark-to-market events, how their footprints come in at the pit open, how these guys are desperately protecting a position, but are getting arbitraged. So what's happening is short-term chart chatter, as we say aside, it's these prices that ultimately translate into a higher physical supported stairstep.
Ongoing supply chain constraints and renewed expectations of upcoming Federal Reserve interest rate cuts are likely to keep driving silver prices higher, reinforcing momentum in gold as it approaches fresh short-term highs. Market dynamics suggest the rally is poised to extend as investors increasingly seek protection in tangible assets amid shifting monetary policy. The silver market is expected to remain tight as above-ground stockpiles continue to dwindle. Recent disruptions in London's over-the-counter markets have significantly reduced the physical silver available, while growing demand has shifted to China, where Shanghai Gold Exchange reserves have fallen to levels unseen in a decade. This scarcity is projected to exert upward pressure on prices as investors compete for the constrained supply. Looking ahead, analysts anticipate that silver will remain in structural deficit through 2026, with industrial consumption continuing to exceed supply. Ongoing investment interest, combined with potential policy changes and supply bottlenecks, points to further appreciation for both silver and gold, suggesting a sustained period of strength for precious metals in the coming months. Will silver's resurgence be a gradual ascent reflecting long-term fundamentals, or could a rapid breakout redefine its historical trajectory in the coming year? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.